There is a recognized psychological bias called the ostrich effect. It is the urge to avoid looking at negative financial information because of how it makes us feel. We leave the bills unopened. We refuse to check our bank accounts. We push them away, hoping the math will somehow fix itself. Look at the alternative. On the other side of that quiet avoidance is a financial culture that screams at you constantly. Social media influencers push crypto day trading, while talking heads shout over each other about the next hot stock. It is loud, it is chaotic, and exhausting. All of this noise creates a false impression. It treats the stock market exactly like a casino, sending a clear message. To build wealth, you either need to be a Wall Street genius with insider knowledge, or you have to gamble your life savings on a lucky bet. Most people look at those two options and freeze. Trapped between paralyzing fear and reckless gambling, they stay stuck in a cycle of financial insecurity, never taking the first step. There is an alternative to the noise. It is an ancient, countercultural approach to money that bypasses the hype entirely. It is the mindset of the diligent steward. The Book of Proverbs puts it this way: "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." A steward understands that before you can gather, you have to patch the holes in your pockets. The crucial first step is to aggressively pay off high-interest consumer debt, like credit cards. Until that is cleared, your wealth is actively leaking backward. Next, the steward builds what we call a peace of mind fund. You calculate exactly how much it costs to live for 1 month: rent, groceries, bills, and you place that amount in a high-yield savings account. It sits there, doing nothing but providing an emotional and practical buffer against sudden emergencies. True investing does not start with buying a stock. It starts with building an unshakable, stress-free foundation that allows you to survive the waiting period ahead. Think of the stock market as a neighborhood marketplace where actual ownership slices of real businesses are bought and sold. The danger lies in trying to guess which single business in that neighborhood will succeed. In the 1970s, Sears was a corporate titan. They built the tallest building in the world. But lean competitors emerged, the business faltered, and the stock crashed. Even massive, globally dominant companies can fail. To eliminate this single company risk, everyday investors use the shopping cart strategy. We call this an index fund or an ETF. Instead of betting your money on one company, an index fund automatically buys a tiny piece of hundreds of top companies simultaneously. If one company struggles, others in the basket are thriving. You guarantee yourself a share of the overall upward growth of the economy without the anxiety of picking individual winners. Smart wealth builders do not waste energy guessing which single house on the block will double in value. They simply buy the whole neighborhood. Owning the whole neighborhood allows you to benefit from the primary driver of market wealth, compounding. This is the mechanism where your money earns money, and then those new earnings start generating their own earnings. The blue line tracks investing $150 a month into an index fund. The red line represents actual value. For a long time, growth is painfully slow, and impatient investors quit. Eventually, compounding forces the red line exponentially upward, driving the value into the millions. Warren Buffett's longtime business partner, Charlie Munger, understood this math perfectly well. He noted that the absolute worst thing an investor can do is interrupt this compounding process by constantly tinkering with their portfolio. Extreme intelligence and perfect market timing are not the secret ingredients to wealth. Decades of uninterrupted time are. Over a 30-year journey, the market will inevitably crash. Recessions will hit. The news cycle will scream at you to sell everything and run. The hasty speculator reacts to these storms with fear. Watching their account value drop, the ant instinctively gathers and stores up provisions. It continues to work steadily, regardless of the shifting, unpredictable seasons. The modern equivalent of the ant strategy is called dollar cost averaging. By fully automating your monthly investments, you remove human emotion entirely. When the market crashes, your automated system simply keeps buying, acquiring shares while they are heavily on sale. Volatility is not a sign that the market is broken. It is the price of admission. Automation is the most reliable way to protect your wealth from your own fear. Let's jump forward in time to survey the result of a steady, unglamorous, little-by-little consistency over the course of decades.
This decades-long effort results in something far more durable than status symbols or temporary luxuries. It produces ultimate financial independence, the capacity to leave a multi-generational inheritance, and the deep peace of mind that comes from a lifetime of faithful stewardship. You do not need to be rich to start investing, but you must start if you ever want to build wealth.